The Fed expects higher inflation and higher unemployment in 2025. That is classic, by definition, stagflationary forces. And I think it's really important to take it from the horse's mouth. We'll start off. We'll kick around some interesting economic trends that we're seeing. First off, as much as the US beats up on California, recent news is that California has surpassed Japan to be the fourth largest economy in the world. So we got the US, then China, then Germany, then California, and then Japan, India, and UK. Very interesting to see that. That's an interesting trend. California, for all of the out-migration that California's had and all the stumbling blocks along the way, still on the rise. I'm always rooting for the US, so I want to see any state be growing and the GDP growing for the states. Also, we saw retail sales hit a record high in March in the United States. Love to see it. Love to see some bright spots on the economy for a change with everything we've seen in the stock market and all the other turbulence across the board. Household spending was up 3.1% year over year. Some recent numbers, very interesting. Consumer sentiment on the way down. That's kind of the bright or the dark spot right now on the horizon of what we're seeing. Sales of newly built homes up almost 7.5% year over year. Love to see that. And then the GDP number. If you guys are following the economy, I'm sure you've seen GDP going on the way down. So we're going to dig into that quite a bit today. We'll see what that number means, what those numbers that are coming out represent, what's backing up and leading to those. And we're going to jump into this. We're going to have some fun. All right, first things first. Today, what are we going to cover? Today we're covering stagflation, and most importantly, how to beat it. We do a lot of webinars. We do a lot of economic deep dives. The most important part of these webinars is not just the data and the information, but it's us trying to give you strategies on the investment side so that you can take these home, you can analyze these, you can go through them with your professionals, and you can make decisions for your portfolio to navigate these crazy times that we're in. We're going to go through what is stagflation, what causes stagflation, the impacts on the economy, how it affects all of us as investors. We're in the community together as investors. Common investor mistakes to avoid. And then, as always, we're wrapping up with live Q&A where you guys can ask me any question that you want. We'll dive in, we'll have some fun, and we'll bounce around some really high-level discussion. Oftentimes that Q&A, we have an investment community that's amazing, very high level, very smart. So that Q&A is really valuable for everybody. But first, in case we haven't yet met, my name is Nick D'Angelo. I'm president at Saint Investment Group. I'm blessed that I get to be considered a thought leader in this space. I get to speak to tens of thousands of investors a year between YouTube, podcasts, stages all over the country. And at Saint, I'm most proud of our performance of what we've done for investors, the amazing team that we have backing things up. Our flagship opportunity for investing is our income fund, the Saint Income Fund, which is backed up by over 500 mortgages in over 21 states and growing, that pays up to 14.28% returns. We've paid distributions on time for over a decade. We never missed a distribution, so we're very proud of that. This is just a brag slide, but I love these numbers so much. Distributed over 13 million to our amazing investors, over 200 million in assets under management, over 10 years of distributions, never missed one to our investors. Also, this is important. I always like to highlight the investors that we have, highlight some of the things that they're saying. So if you want to learn more about us, one, I could show you some: trustworthy, knowledgeable, grounded. These are three words that I think of when it comes to Saint Investment Group. But more importantly, why don't you Google us? If you're ever curious about Saint, Google us. Trustpilot has a ton of reviews. Google has a ton of reviews. You'll see us all over the place. So I recommend Googling us and checking us out further if you're ever curious. And then also we got a ton of testimonials on the website. You can see some great people that have great things to say about us on this slide. We also have them on the website for you to check out as well. And then, just to highlight the investment opportunity, our flagship on the table today, up to 14.28% returns. These are paid by single family mortgages primarily throughout the US, only in the United States. If you at any time during what we're going through today, I want to make sure I give you the tools to learn more about us and what we're doing. You can text Tom, you can call Tom, or you can book a call with Tom. Tom is our Investor Success Pro. He's extremely helpful. We just dropped his calendar link in the chat. Tom, after our conversation earlier, why don't you just drop your number also? If you guys want to text Tom or call Tom, you can do that right now during this presentation. Get on the phone and learn from him directly. He's standing by, happy to help and customize and walk through your personal situation. Otherwise, if you want to book a call with Tom later, you have the link in the chat now. There you go. Tom just dropped the number. So if you want to get in touch with Tom Furlong, our Investor Success Pro, you guys can have some great conversations and learn more about our strategies and what we are doing at Saint. So here's the outline for today. We'll break this down. First, we're going to go through a legal disclaimer. We're going to keep the attorneys happy. Then we're going to dive into stagflation and how to beat it. The topic for today, lots of good data, lots of good strategies there. We'll wrap up with a little bit of housekeeping, and then we will transition into live Q&A, going over any questions that y'all have. So let's kick this off. Let's jump into a word from our legal team. You guys can read through this, but the big takeaways are the following. One, this is not investment advice. This is for educational purposes only. These are deep dives that we do. We're constantly evaluating the economic environment, the economic landscape. We're always looking and stress testing our own strategies. So we just want to share these with you guys. If it means us putting together some slides and showing you what we're looking at, that's a pretty good opportunity to give back to the community. Also worth noting, all investments carry risk. Past performance does not ensure future results. That is throughout the investment world. We will show you examples of all kinds of different investments that may not have the same performance in the future. We'll be diving into those today. So good things to know moving forward. And I love this piece right here. This is a book giveaway that we started. We try to give away a book every month that drills down on interesting angles of the economy, drills down on interesting facts and data. Leanne, to answer your question, no, Tom is not a financial advisor. He will only be talking about what Saint offers and can walk you through that. So he is not a financial advisor, to answer directly, Leanne. But this is one of our favorite new things that we've added to webinars. This is a free book giveaway for the people that engage best on what we're doing here. So there are a few ways to earn the book, but most importantly, why this book? So Thomas Sowell is an amazing economic writer, economic author, and he drills down on all kinds of amazing detailed economic insights, high quality breakdowns, and makes them really simple and easier to understand. But this book in particular has one thing that's very special to it. He sheds light on topics that we don't cover or see covered meaningfully by the mainstream media. That's one of our favorite things at Saint. Most of the topics that we cover are trying to shed light on things for investors that they won't see in the news, they won't see that are drilled down clearly enough or detailed enough for them to understand. This book goes over very interesting ranges of topics like gender pay gaps, economics and race, how it impacts different race, the economic views and income structures, how the economy today impacts different earning wages at different levels. These are touchy subjects, but what I love is that Thomas Sowell has opened the dialogue on these. I don't even agree with everything in the book, but I think it's extremely important that we're leaning into these conversations as we come into more complicated economic times, these conversations are more important than ever. How do you get a free book today? How do you win the book giveaway? We don't have a set number of books that we give away. We just give them to the best engagers. So the way to get books today, comments in the chat, questions in the chat, responding to polls that we will do throughout this presentation, and then leaving reviews on our Trustpilot page. So for the best engagers, we can't wait to give you a book. We read them also. So it's a really cool way to check in with each other, kind of have ongoing economic discussions and understand the market better together. So I've really enjoyed this. So engage with us, drop questions, leave reviews, and we'll send you a book here. And if you have to leave early or you don't get a chance or you're not able to engage today, we also included the QR code so that you can just go buy the book on Amazon and get it for yourself. So let's kick things off here, huh? Let's jump in. Inflation is soaring. Growth is stalling. Markets are volatile. Welcome to Stagflation. This is, by all intents and purposes, the ultimate investor challenge that we're talking about today. Stagflation, simply put, describes an economic condition that is characterized by the simultaneous occurrence of stagnant economic growth, high unemployment, and persistent inflation. This is a combination that defies traditional economic models. In the next slides, we're going to explain why stagflation is so difficult to manage, what causes it, and what it means for all of us. Okay. So stagflation this is a basic breakdown. You can kind of see the three big indicators of a stagflationary environment. Stagflation is unusual because in traditional economic models, high inflation and high unemployment, typically don't occur together. Normally when unemployment is high, inflation is low, and vice versa. But stagflation defies these models. It makes it very complicated and difficult for policymakers and really for us as investors, the everyday retail investor as well. I'm going to take a moment here and talk about a little bit of inside baseball. I've talked about this on a few different webinars, but it's very important for this topic specifically. Let's talk about the Phillips curve. Let's do a sidebar on that. The Phillips curve is an economic principle that basically creates a seesaw effect between unemployment and inflation. So when unemployment goes down, that means more people are employed, make more money, they spend more money, and the demand for goods and services go up. So that means inflation goes up, right? So low unemployment typically equals higher inflation. On the reverse, if unemployment goes up, less people are employed, they're making less money, so they're spending less money. So that typically drags down inflation. This seesaw is a classic economic principle, and it's really important because it affects all aspects of our economy. The Phillips curve is literally the basis for the Federal Reserve's dual mandate. So the Fed is mandated by Congress to manage the economy in the US by balancing the Phillips curve. They have a target of 4% for unemployment, which is considered full employment by the economy. And then they have a target of 2% inflation, which is a good balance for price increases over the next year. Stagflation is difficult because it throws all of these principles out the window. It's the breakdown of the Phillips curve, where unemployment and inflation are actually both high. So it represents what is likely the worst case scenario, especially for the Federal Reserve. So why is stagflation so rare? Why is it such a feared situation? Because it's essentially taking the standard economic playbook and really throwing it out the window. When policymakers like the Federal Reserve try to stimulate economic growth, for example, by lowering interest rates or increasing government spending, classic examples, it can actually make inflation worse. So more money in the economy means prices are likely to rise even faster, right? But on the flip side, if they focus on fighting inflation by, let's say, raising interest rates or cutting back on spending, it can slow the economy down even more. which often leads to higher unemployment and even weaker growth. So every move to fix one problem often makes the other problem worse. So this leaves policymakers in a really tough bind. This is the classic catch-22 or between a rock and a hard place. So there's no easy solution, and it's why stagflation is really rare. We've only seen it a handful of times in US history, and it's also very challenging for governments and central banks to manage. So when there's stagflation, what policy responses are there and what are their investment implications? Let's start digging into the details here. So central bank actions, let's start there. Central banks face difficult choices, simply put. Raising interest rates combats inflation, but may worsen the economic contraction that we'd be experiencing. So if rates rise significantly, interest rate sensitive sectors like real estate or like utilities and many others might underperform, while there are some financial companies that could benefit, specifically lenders or people dealing with debt, but that's kind of a really, really small sector of the economy. We also have fiscal policy measures. Governments may increase spending along the way, which we alluded to stimulate the growth despite the inflation concerns. So these are things like infrastructure spending. These are things like investing into different aspects of the government, into the government workforce, right? These typically benefit materials. These typically benefit construction, engineering companies, etc. Companies that really are more on the backbone of the country. That's largely good, but can also stimulate growth to inflation. So if you're looking at fiscal policy measures, what you're looking for are targeted subsidies in strategic sectors like clean energy, domestic manufacturing. Things like that could really, really benefit from that side, from that, fiscal policy, that government intervention. But inflation also rises typically. Then we have trade and currency policies. Protectionist policies often increase during economic stress. We're seeing this today. We're seeing a lot of these policies coming up in discussions today. So companies with primarily domestic supply chains are likely to have the biggest advantage. But on the flip side, you'll look at multinational companies. These are companies, offshore, non-US based. They are likely to face a lot of headwinds from trade restrictions, from protectionist policies, etc. Some of that's by design. You look at the Trump presidency, you look at a lot of what they're doing right now, many of the protectionist policies or many of the policies they're bouncing around are against outside investment by design, outside non-US based companies. All policy responses to stagflation create both risks and opportunities for investors. That's the good news. There are opportunities that come out of this. But monitoring these regulatory changes and policy shifts becomes crucial for us as investors and positioning our portfolio. The tension that we're going to see in stagflationary times between inflation and stimulating growth typically leads to inconsistent policies that will increase the volatility that we experience. This is the zigging, this is the zagging, right? This is the trying various strategies to see what works, even if they're in conflict with one another. So it puts us as investors in a difficult position, and it's tougher to find your footing. Okay. I really, really like, in complicated economic times, just to go to the source here, let's check out Jerome Powell. On April 16th, Jerome Powell, the Federal Reserve Chairman, talked about the unusual economic scenarios that we're dealing with today. High unemployment, high inflation, how they could coexist together. We're going to pause for a second here, and we're going to watch a short clip from the most recent conference that Jerome Powell was at, going over this exact topic.
We're talking about the future. You may be confronted in the not so distant future with both higher levels of unemployment as well as potentially higher inflation. And of course, the policies that each one requires could be different. You talked a little bit at the podium about how the Fed would see these two and how it would address it. Just giving you a chance again to elaborate on that.
Right. So most of the time, when the economy is weak, inflation is low, and unemployment is high, and both of those call for lower interest rates to support activity, and vice versa. So most of the time, the two goals are not in tension, and they're not really in tension now. The labor market is still strong, but the shock that we're experiencing, the impulses we're feeling, are for higher unemployment and higher inflation. And our tool only does one of those two things at the same time. So it's a difficult place for central banks, to be in terms of what to do. And so the best we can do is we actually have a little provision in our consensus statement, which is the thing that we vote on to embody how we approach these questions. What we say is we will look at how far the economy is from each of those two goals, and then we'll ask, might there be different paces at which they would approach those goals? We'll look at those things and think about them, and we'll make what will no doubt be a very difficult judgment. Again, we're not experiencing that now, but we could well be in that situation, as I mentioned in my remarks.
Okay. That's straight from Jerome Powell's mouth, right? This is a very short clip, minute and a half clip. The entire presentation, which is not just Jerome Powell going live and speaking at the podium and walking through some really important points and facts of what he's seeing, but there's also this sit down like we just showed. This is very powerful, but it's 46 minutes long. So I won't go through all 46 minutes and play that live here, but Ange, do you mind dropping that link in the chat? We're going to provide you guys the link so that you can go watch the entire presentation on your own time when you have time. But we've watched it for you, and we're going to go through the highlights in the next slide here. Okay. Here's the economic outlook, and this is what they go through in the presentation. This is what Jerome Powell goes through in his presentation. There are four main takeaways here. Number one, the Federal Reserve does not expect to cut interest rates at the next Fed meeting. That's number one. Number two, the Federal Reserve, from Jerome Powell's mouth, expects higher inflation in 2025. Number three, the Federal Reserve expects higher unemployment in 2025. And last, the Fed does not expect to be proactive. They plan to be reactive to what they see and the trends that they're seeing. Now, some of this might be because Jerome Powell got slapped a little bit for being a little too proactive in the wake of COVID-19. Remember, he printed 80% of every US dollar in history in a very short period of time, and that led to 9.1% inflation in the middle of 2022. But the two big takeaways that I'll re-highlight here: the Fed expects higher inflation and higher unemployment in 2025. That is classic, by definition, stagflationary forces. And I think it's really important to take it from the horse's mouth. Okay, so we've identified stagflation. We've went through what the Federal Reserve has to say about it, but let's back up a minute and talk about the causes of stagflation. Stagflation typically results from multiple factors converging at one time. So let's break down the four main causes that we see. The first, hold on 1 minute here. There we go. The first is going to be supply shocks. These are sudden disruptions. These are an oil crisis. These are a natural disaster. These are things that make it harder or more expensive to produce goods. So when costs go up across the board, prices rise, but businesses may also cut back, slowing the economy. So supply shocks can have a net negative effect across the board on both sides of the economy. Second, we have structural imbalances. This means there are problems within the economy itself. These are things like labor market problems, regulatory problems. These are examples like when it's hard for people to switch jobs or for companies to adapt, the economy can't respond quickly enough to changes. So this leads to both high unemployment and the high rising prices. The economy in this case becomes less nimble and less adaptable. So we see stagflation be pushed by structural imbalances. Third, we see monetary policy error. I mean, guys, we've seen a lot of this over the last few years, right? But sometimes central banks, for instance, print too much money, or they keep interest rates too low for too long. like the last 10 to 15 years. They're trying to boost growth, but if the economy isn't actually growing from that investment or from those rates being too low, what happens is the extra money just pushes prices up without solving unemployment. So it's a net negative if you print too much money or keep rates too low for too long without the positive of boosting or bringing down unemployment. And then finally, we see external factors, things that are relatively outside of a country's control. We see wars, we see trade disputes, even pandemics, right? All of these can disrupt supply chains, create uncertainty, and put shocks in the system that drive up costs and slow down growth at the exact same time. So again, stagflation usually happens when multiple factors overlap and make it tough to solve the problem because you're dealing with both inflation and stagnation at the same time. But let's take a history lesson here. I think it's important. The most obvious example in American history is going to be stagflation in the 1970s. So let's look at what triggered stagflation in the US in the 70s first. First off, we saw the oil embargoes. We saw the OPEC embargo. In 1973, we saw major oil-producing countries completely cut off supplies to the US and other nations. This caused major major price increases on energy. This sudden jump in cost rippled through our entire economy, pushing up prices on everything from gasoline to groceries to things that we didn't necessarily expect to be impacted so dramatically. Oil alone saw a 4x increase in price, and this affected all downstream pieces of the economy from there. Because, think about it. Let's take an apple as an example. When you have an apple, you're not paying just for the water or the land or the fertilizer to make that apple, right? You're also paying for the transportation to get that apple to the farm, or from the farm to the grocery store, and then from the grocery store to your house. So the supply shock in this case of oil, oil prices going up 4x, it affected the entire US economy. So that was one dramatic example of the causes in the 1970s. Next, we had massive monetary policy shifts, some of the biggest in our history. The Federal Reserve struggled to manage inflation, sometimes keeping interest rates too low for too long. Is this sounding familiar yet, right? This made it harder to bring rising prices under control because they weren't reacting fast enough. Basically, the Federal Reserve waited to be reactive and not proactive. This is also similar to the last decade that we had of the artificially low rates. Third, we had the end of the Bretton Woods system. This was a turning point, major US turning point in US currency and economic policy, because before this moment, the US dollar was on the gold standard. We were tied to gold, right? We were on the literal gold standard. So in the early 1970s, the US abandoned this system completely, leaving the gold standard and leading to more volatile exchange rates, leading to massive inflation on that side, because we were now dealing with a currency we weren't used to managing. So what was the result? The result was that the US experienced a rare, painful combination. We saw inflation rates soar above 12%, while we saw unemployment climb over 8%. This was the most clear, most obvious, and most dramatic pace of stagflation that we've had in US history. Bad economy, high inflation, high unemployment, all happening at the same time. So more or less, these triggers combined to make stagflation especially difficult to solve, and they left a mark of things that we still deal with to this day. But speaking of today, let's talk about today. Now that we've covered how tariffs and other policies could trigger stagflation, let's zoom out and look at the bigger picture, the current economic landscape. I'll let you guys look at this chart. This is an important chart. One of the main factors that lead to stagflation, unemployment. This graph shows the US unemployment rate over the last 6 years, so pre-COVID all the way to today. Let's start on the left. Unemployment was historically low in 2019 and in early 2020, hovering right around that 3.5 to 4% range. This is a sign of a strong labor market. This is good. These are good numbers. This is what the Federal Reserve classifies as full employment, okay? Then in early 2020, we saw a pretty dramatic spike in unemployment. This was COVID-19. This was the pandemic. Unemployment shot up to nearly 15% almost overnight as businesses shut down. The government shut down businesses proactively. Millions lost their job, pretty much all while the economy held on for dear life. The good news is that the recovery was relatively rapid, right? As the economy reopened slowly in different places, depending on the state, unemployment fell throughout 2021 and into 2022, and eventually even returned to pre-pandemic levels, back to full employment by Fed standards. So if we look at if we look at more recent data, let's look at 2023. We started to see that unemployment has gradually crept up. So now today, if we look at today, we are just over 4%. So this is still relatively low by historical standards. That's good, but it does reflect that we have some cooling off in the job market. I'm going to show you guys some data. I'm going to read some data from you that we just pulled from the New York Federal Reserve, okay? The title is Pay Expectations Are Deteriorating. Here's the quote. The average lowest wage applicants would be willing to accept for a new job sharply retreated to 74,000 from a series high of 82,000 in November. This decrease was most pronounced for men and respondents over the age of 45. This is roughly a 10% reduction in the wage that people will accept, according to the New York Fed at their most recent report. Now, they pointed out that this most affected men and people over 45. This is a huge portion of the population that are essentially receiving a 10% reduction in the pay expectations that they have. So unemployment and pay are concerning variables that are not good right now in the US economy. What's the big picture here? This chart highlights how quickly the job market can change in response to major events and how resilient it can be with the right economic support. So it also gives us an understanding of today's labor market challenges that show a declining labor market, and the fact that what's coming next might not be really all that positive as far as labor is concerned in the US. I like this slide. This is a good slide. This gives us insight directly into what the Federal Reserve is looking at. This slide shows two key measures of inflation in the US for 2024. This shows core PCE and headline PCE. These are good, and they're even better to see side by side. PCE stands for Personal Consumption Expenditures Price Index. This is basically the alternative to CPI, which we used for many years, or Consumer Price Index, which is another measure of tracking inflation. PCE is what the Federal Reserve specifically uses to gauge inflation because it covers a pretty wide range of consumer spending, and it also adjusts for changes in behavior. So this is the new metric that the Federal Reserve is looking at when they're tracking inflation. Let's start with headline PCE. Headline PCE includes all items. So it captures everything. It covers everything consumers buy. So this includes food and energy, okay? In 2024, headline PCE fluctuated due to swings in energy prices and some food costs. We saw spikes early in the year, but overall headline inflation trended slightly downward as the year went on. Let's take a look now at core PCE. So core PCE is the same numbers, but it excludes food and energy prices. No food, no energy. The reasoning for this is that food and energy tend to be more volatile. I mean, I don't know. I don't really agree with that. I mean, I personally eat food and I personally need gas for my car to get to work. But, I do want to know what the inflation impact is on those. But we'll go over core PCE because it's something that they look at. The thought is that this gives us a better sense of the underlying persistent inflationary trends. So in 2024, core PCE stayed more stable than headline PCE, but it did stay above the Fed's target of 2%. Why does this matter? Which is my favorite question on every slide, by the way. Why does this matter? Because we go into details, so I always want to circle back how this affects you as the investor. The gap that we see in this chart between core and headline PCE tells us how much of inflation is being driven by temporary factors, like oil prices, versus more persistent factors like housing or services. So what's the big picture on this? Even though inflation did cool a bit compared to 2022 and 2023, both measures stayed above the Federal Reserve targets. That's the point here. Right now, inflation is above what the Federal Reserve is targeting. This has kept pressure on the Fed to maintain higher interest rates and has also influenced everything from mortgage rates to investment decisions to credit cards to stock returns, blah, 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 all of it. So in summary, while headline inflation was a bit bumpy, core inflation had stubbornness, and this is why the Fed remains cautious about when they don't want to claim that they've solved inflation because they're still above their target. So as a summary, unemployment is above Federal Reserve targets, and it looks to be getting worse. And inflation is above Federal Reserve targets, and it looks to be getting worse. Jerome Powell himself, just a couple slides ago, said that both of these will continue to get worse over the course of this year. So with these facts in mind, if we just looked at these, we're staring at the exact numbers that the Federal Reserve is concerned about a stagflationary environment. Rick, yes, you're right. That's supposed to be January 2025. Good catch. So we looked at the big picture, right? We looked at the big picture. We looked at the broad scope of unemployment. We looked at the broad scope of inflation. Let's drill down slightly. Let's look at how businesses are being impacted by these trends that we're seeing that we just went through. This chart that we're staring at here is based on a Federal Reserve Bank of New York survey. Okay, this tracks how business costs have changed for manufacturing firms and for service firms in the markets of New York and New Jersey from 2022 to 2025. This chart that we're looking at here is highlighting the trends in cost increases over these years for these respective businesses. So it gives us a clear look at kind of different sectors and how they're experiencing the rising costs. I like this for a zoomed in example. Let's go into the numbers. The average cost increases for service firms in this market dropped from 11% in 2022 to 6.1 the following year and 5.1 the following year. That's good. Cost decreases, less to be passed along to us as consumers. That's a good trend. For manufacturing firms, it slowed from 5.3 to 3.7, then rose to 4.8, right? We see that right in this neck of the woods of this chart. The notable increases for manufacturing firms, just to drill down one extra layer, they saw metals, electricity, and freight. If I'm zooming in on manufacturing, the last things I want to see increase are metals, electricity, and freight. Okay? That's a big part of the manufacturing sector. In 2025, service firms expect costs to rise 5.7%, while manufacturing firms anticipate a jump to 7.3%. This is what we're estimating this year for this market to incur on cost increases. So it's a zoomed in example, and unfortunately it's painful. Now let's shift gears to GDP, right? We talked about a few different examples. Now we're down to the third example, the third trend that would drive stagflation. Let's see what that looks like. U.S. gross domestic product, or GDP. This is basically the measure of growth or contraction for the economy in the U.S. This is the key indicator of economic activity for the U.S. economy. But the official estimate of GDP is usually released with a delay, okay? There's a lot of data that they have to get through. They need to organize it, digest it, confirm it, and do all that before reporting it. So what we're looking at here is what's called the Federal Reserve, the Atlanta Federal Reserve's GDP Now estimate. What the GDP Now estimate is basically a spot check on what they expect to see. It's what their numbers are showing them, and it's much more up to date. It's in the recent quarter. The most recent GDP Now model that the Federal Reserve is showing is a real GDP growth rate of negative 2.8%. Okay, so this is what it was doing. This is the GDP rate dropping dramatically. This is a major downswing in GDP in the US estimates. This is the stagnant part of stagflation that we're looking at here, that we're staring at here directly from the Federal Reserve. This is the country's economy contracting. This means businesses are declining. This means people are making less money. This means less tax revenues for the government. This is a big deal, what we're looking at here. One thing we like to give you guys are tools, charts, graphs, things that you can utilize, things that you can spot check as we see different changes in the economy. That's this chart here. This chart is an interesting example of some high and low watermarks that we've seen being used by big financial companies, economic evaluation models, etc. The first column is the indicator, so what we're looking at. Second column is the reading level, and then the third column is the meaning if the numbers are above or below what the second column is showing, okay? So monitoring these indicators, what it does is it gives us early warning signs of economic conditions on the horizon, okay? So it's kind of like a spot check of what could be coming up and what we classify the data at. Let's walk through these for a second. Economic stagnation, right here, first row. When it's below 1%, we're looking at potential economic stagnation. Well, what about negative 2.8%, which is what we just saw on the last slide? Not good, right? CPI and core inflation, 5 and 7%, we're not quite there, but we do know that inflation is on the way up, and the Federal Reserve is predicting it to go up even more. Labor force participation. We don't want to see this go below pre-pandemic levels. The issue is that during COVID particularly, we saw huge shifts in the labor force in the US. Not only have we been seeing a longer trend for decades of lower participation rate in the workforce, in the labor force in the US, but we also saw the baby boomer generation disproportionately just leave the workforce. They said, hey, now's a good time as ever to exit. Most of the baby boomers are the generation is largely shored up, the wealthiest generation we've ever had, as well as the largest generation we've ever had. And they left in droves of the workforce. They left the workforce in droves during the pandemic. Also, the last one I'll highlight, wage growth versus productivity. Pay particular attention to this, okay? When wages rise without productivity arising, this is an early indicator of inflation. Okay, this is an interesting one, but this means we're paying people more, but getting less productivity out of them. That leads to inflation in the in the economy. So this is a good slide to understand if you're looking at the horizon of what's coming up and what levels to be keeping in mind and what they mean. Okay, let's dive into politics. Let's talk about the potential impacts of Trump's tariffs and whether they could lead to stagflation. Now, before I get too far, let me set the table. I'm a lifelong independent, okay? I vote on both sides of the aisle. I'm an economic voter, meaning I vote for whichever party, whatever their policies are that I think will be best for the economy in the US. I'm pro-US. I want US citizens to have more money in their pockets. So that's how I'm always looking at any political environment, is through that lens, just to give you guys, just to be upfront with what my bias is, okay? So let's first talk about tariffs. What exactly are tariffs? There's an interesting study that came out. This recent study said that 55% of Americans, so over half of Americans, don't even know what a tariff is, okay? They're not even clear on what exactly a tariff is. Interestingly, a second study came out, and it showed that over 90% of Americans had really strong opinions about tariffs. Okay, are you guys tracking with me? Over half of Americans don't know what tariffs are, but nearly 100% of Americans have very strong opinions on tariffs. We need to change this. This is an aside. This drives me nuts that mainstream media is not giving people enough deep dive into the economic basics that we're dealing with today. But Anyways, I just thought those were funny studies side by side. Now, what are tariffs? Tariffs, simply put, are a tax on imported goods. Okay? Tariffs are a tax on imported goods. When tariffs are imposed, the cost of bringing in products from other countries goes up. That extra cost that's assessed, that extra tax that's assessed, is usually passed on to consumers. This oftentimes brings prices higher and adds to inflation. Simply put, tariffs are typically inflationary, but it doesn't stop there. Higher prices on imports don't just mean inflation. They also make it more expensive for businesses that rely on those goods, the downstream effects, right? This can slow down economic growth because things are more expensive. So companies may cut back on hiring. They may even lay people off if their costs rise and their demand falls. So unemployment can then go up along with inflation, right? Remember when we talked about the OPEC embargo in the 70s? That led to the greatest stagflationary environment in US history, right? So, okay, remember that was caused by a supply shock in oil. Oil supply was crushed. We had quadrupling prices of oil, and that led to massive inflation. But we also had a stagnant economy. We had low GDP. We had high unemployment. So stagflation was triggered by all of those things converging at one time. John, will do. Thanks for dropping that note there. Absolutely. So now think about the tariffs. Let's drill down. What are tariffs? What are the impact of tariffs? They are a drastic shock to supply, right? Just like in the 1970s. We're already dealing with GDP estimates that are now negative, and the jobs numbers are receding and going backwards. So this is starting to sound familiar. Supply shock, bad jobs numbers, bad numbers of GDP. History doesn't repeat itself, but it does echo, right? So this combination, the rising prices, the slower growth, is exactly what we call stagflation. Normally we see inflation when the economy is booming, but with tariffs, you can get both inflation and stagflation at the same time. So this is exactly what Jerome Powell was referring to. Now, right now, to talk more on the tariff specifically, the risk of stagflation from tariffs is higher than ever before in US history, with tariffs being proposed at historically high levels, sometimes up to 60%, like China, and even talks of tariffs on goods from other countries. These policies could quickly raise prices across the board and put pressures on jobs and growth. The last time, just to wind back the clock, the last time we had tariffs near this level was roughly 90 years ago. And the levels that we're looking at today are the highest that we've seen in history, okay? So in summary, if these tariffs go into effect, we are likely to see higher prices for everyday goods, slower economic growth, and potentially more unemployment. These are all ingredients for stagflation. So at least in the short term, the risk of stagflation due to tariffs has risen quite a bit. Now, here's the question. Will Trump tariffs cause stagflation? You can see some examples from the news. CBS, CNN, Bloomberg, Barron's. We're not quite that surprised to see CNN hate on Trump. That's probably not a huge surprise to anybody. I think he spent 4 years calling CNN the Clinton News Network. But anyways, the others, I mean, it's interesting to see that they're all pretty concerned in the last little bit, in this last short period of time. They're all concerned about stagflation here. Trump is considering significant tariff hikes, like we said, 60+% on Chinese imports, broad tariffs 10 to 20% on all imports from all kinds of different countries in all kinds of different cases. The goal with Trump here, as stated, is to boost U.S. manufacturing by making foreign goods more expensive, which would give, in theory, give domestic companies a better chance to compete by making manufacturing and making goods here on U.S. soil. Let me take a minute here and offer a balanced perspective. First off, imported goods into the U.S. represent only roughly 10% of the U.S. GDP. So current GDP in the U.S. is roughly 30 trillion. imports are roughly 3 trillion, okay? But the biggest concern is that these imports affect the costs of other businesses and will continue to drive up prices across the economy, much like we saw the oil situation, right? So the bigger question is, what are the broader effects of these imports and of these tariffs to other businesses downstream? Also, the goal of these tariffs are to bring manufacturing to the US, like I said, and give manufacturers a leg up. I actually believe this is a very good thing. Now, again, I'm extremely pro-US business. We see investment into US manufacturing from major companies, and I think that's good. We see Honda, we see Hyundai, we see Taiwan Semiconductor, Apple, many others on the horizon as well. But these are going to take time. We know that these are going to take time. When I say take time, the estimate is 2 to 5 years for this manufacturing sector in the US to get built up and to be brought up to speed. So that means it could be many painful years between now and then, right? We would need a stable Trump during that time also, okay? So for the good things Trump's done for the economy, and he has done some, we've seen NAFTA too, we've seen some positive negotiations coming with other countries, Trump can also be volatile. We know that he can zig and zag. We know that he can change his mind. And we would need a stable investment strategy as investors to be backing up a lot of these big plans. All of this would be best case scenario. Okay, now let's shift to the downside scenario. The downside is that tariffs could raise the cost of imported goods in the immediate term, right away, which can quickly lead to higher prices immediately for consumers, for businesses, etc. This is inflation 101. Right? Simply put, especially since over 1 trillion in imports to the US go directly to US consumers today. And at the same time, if tariffs slow down trade or trigger retaliation from other countries, we're looking at a potential economic slowdown and even, more of a weak outlook on GDP that we can expect in the US. That's the classic recipe for stagflation. I keep putting a pin in that to make sure that we're tying the loop between stagflationary forces and the different things we're covering here. Historically, tariffs have typically resulted in higher costs for consumers, but the issue is they outweigh any revenue gains from the government because it's a tax. So the government gets that revenue from the tax, okay? So this is where it gets complicated, because there's also a risk of tariffs, retaliatory tariffs that the US would have to deal with from other countries on things like key inputs, things like metals, things like electronics, things like construction materials. If these costs are raised for US manufacturers, then that actually makes the US-based manufacturers less competitive overall. So while we want to bring manufacturing back to the US, if the inputs that these manufacturing companies are using have retaliatory tariffs on them and their costs go up, this could lead to a negative effect even on US manufacturers. This personally, for me, is the #1 concern when we build out our manufacturing sector in the US. Here's the good news. The US is extremely blessed with how many natural resources we have. Many countries don't have the natural resources we have. Look at China, for example, nowhere near the energy and many other natural resources that we have. But we don't have everything, okay? So if other countries retaliated on key materials, that will make our manufacturing build out much more difficult. So what does all this mean? While tariffs might help some US industries over the longer term, let's say 2 to 5 years, there is an immediate risk of fueling inflation without boosting net economic growth. Stagflation. But now we've drilled down a little bit. We've jumped into tariffs. We've jumped into some of the potential supply side shocks that we could be dealing with on the horizon. Let's look at what other people are saying, right? We looked at some of the news headlines. Many of them can be sensational, but what this slide represents is an amalgamation of different data that we've put together from different sources of what they're seeing and expecting broken down into a pie chart. The expert opinions that we're seeing, I mean, obviously they vary very much. They vary widely on stagflation and what the outlook is. The most likely scenarios involve either extended stagflation or a recession that's followed by a recovery, okay? The duration of this will depend a lot on supply constraints like we talked about, how quickly these are resolved, and then the policy responses that our government does in response to the different variables that will come up in the future. History suggests that stagflationary periods typically last around 3 to 5 years before economic adjustments catch up, right? Before they start restoring growth, they start controlling inflation. And this lines up pretty well with that 2 to 5 year window that we talked about in a moment ago, that it will likely take to build out the US manufacturing sector. So those two timelines kind of track. That doesn't mean this process isn't extremely painful in the short term, right? In the 1970s, to use that case study again, this took Paul Volcker coming in as the Fed chair, so coming in the role that Jerome Powell sits in today, and Volcker made drastic changes in order to get things on track. In order to solve stagflation, Volcker had to make a tough decision. Does he want to tackle stagnant economic growth, or does he want to tackle inflation? Volcker went first for inflation. That was his choice. What he did to tackle inflation was raise interest rates to over 20%, the highest levels in US history. So in order to solve the last round of stagflation several decades ago, we had to pull out some of the most extreme economic policy that we have ever seen in the US. Okay, let's hope it doesn't get to that, but it's good to know what it could look like in a worst case scenario. The structural factors that we're seeing that could cause things to get wonky here, we're talking demographic trends, deglobalization, the energy transition. All of these could extend the stagflationary period compared to historical periods of stagflation. So what's the takeaway? Investors should prepare for potential longer challenges, right? We're talking 2 to 5 years of challenges ahead, while staying alert for signs of economic changes that will require portfolio adjustments on your end, on our end, us as investors in the investment community. Okay. Stagflation and investors. We're getting into the meat here, how this impacts us as investors. So stagflation creates a uniquely difficult environment. We've talked about that. The problem is that traditional safe havens, things that we've done historically that have worked well, may no longer provide the protections that we've come to expect from them. The combination of this stagnant growth from businesses, from the economy, the combination of this and rising prices means that even, things like cash might go back to that old saying, cash is trash. The core value eroding from cash in this situation would be caused by this inflationary pressures, which would reduce buying power from us as investors if we're sitting in cash. So let's take a closer look at different asset classes and see how a stagflationary economy would require rethinking a lot of these portfolio strategies. All right. So let's talk about some of the risks that we see on the horizon that will impact investors. First, traditional diversification may not protect portfolios like it used to, right? When inflation and stagnation hit together, when they hit at the same time, when they coincide, many asset classes can move down at the same time. So this reduces the benefits of both styles of investing, right? So if things are hitting at the same time, it might draw down and reduce value of multiple asset classes simultaneously. Next, purchasing power erosion is a very real concern in a stagflationary environment. Inflation is likely to outpace many investment returns, meaning even if your portfolio is growing on paper, you might actually be losing ground in terms of what your money can buy. We see this as a situation where inflation would exceed maybe treasuries, right? Not a crazy scenario. We saw that in the last handful of years. We're also seeing market uncertainty go crazy. Volatility is up across stocks particularly. We're also seeing it across bonds. We're also seeing it in multiple sectors of real estate. This makes it that much harder to predict outcomes, to project outcomes, and to plan for the future for all of us as investors. And finally, recovery periods are typically longer in this type of environment. It can take years, not months, but years for portfolios to bounce back after a downturn caused by stagflation. So the key takeaway here is that stagflation and persistent inflation change the rules of the game. They are not normal scenarios that we have. They're not normal scenarios that the Federal Reserve has plans for, okay? So investors need to be more selective than ever on what assets they're choosing. Got to focus on resilient assets, things that will benefit and navigate this era well, and prepare for a longer road to recovery, a longer period ahead. So let's drill down on the different investment classes and see how stagflation might impact these. Like we said, traditional investment approaches suffer dramatically during stagflation because you're getting hit by both sides. What we're seeing consistently, what we're seeing not just from our own research, but what we're seeing covered regularly in the breakdowns, are that the traditional 60-40 stock bond portfolio that typically people have leaned into underperforms because both asset classes faced headwinds at the same time, okay? Equities, stocks, they struggle with profit margins. Profit margins are compressing in environments like this. Reduced consumer spending is a very real concern. We see companies having major issues with the economic slowdown or stagnation or even going backwards, contraction, right? At the same time, we see bonds face the challenges of rising interest rates and inflation eroding real returns, okay? So we have this conversation with investors regularly. If treasuries pay, let's say roughly 4%, right? And we see inflation, oftentimes, especially in recent years around the 3% mark, that's a 1% net return that investors are sticking with, right? That they're experiencing. Is 1% in a good environment enough for an investor to feel comfortable? Well, only that investor can answer that. But many of our investors, that's not a good fit for them. And that's too close to comfort. And there's not enough meat on the bone for the economic uncertainty that's going on today. So this creates a really unique and particular challenge in this kind of environment, especially for retirement planning, because safe withdrawal rates will likely need to be, revised downward as people are going through their different retirement plans. So it's a tough time across the board, but planning accordingly gets you out ahead of it. So what strategies can we utilize during during stagflation? One, being defensive, finding defensive stocks that benefit or navigate the situation well. Two, we have commodities and precious metals. I'm not a big fan of commodities personally. I just don't like the idea of trying to, wheel around a bale of wheat or, carrying around bars of gold. And, usually there's no cash flow, tax, advantages are pretty limited, but commodities have historically provided one of the most effective hedges against inflation and stagflation. They have something that's unique in today's financial world. They have intrinsic value, okay? So assets that have intrinsic value at the core of what they are, physical assets commonly, typically rise in value with inflation, okay? They have limited supply, so those characteristics can protect investors against things like currency devaluation. So in this case, what we commonly see strategy-wise is allocating 10 to 15% of your portfolio to a diversified commodity basket during inflation and stagflation. Next, real assets, my personal favorite, right? Saint, we are a real estate company. We are all in on real estate. We love real estate. That is what we specialize in, real assets. Real assets also have intrinsic value. They also have cash flow. Oftentimes they can have different added advantages like tax advantages or growth advantages, but real assets have intrinsic value. So they're a good inflation hedge in most market conditions. And then last, we have dividend paying stocks. This is a return to Warren Buffett strategies, right? The value investing approach. Value investing typically outperforms growth during stagflationary periods. So looking at companies with strong current cash flows, reasonable valuations, not the crazy PE ratios that are way overvalued, and the ability to return capital to shareholders through dividends. These are companies that weather stagflation better than high multiple growth stocks that have, very speculative value on that side. Ange brings up a great point, guys. We'd love to hear from you at this point. I'm going to push this poll up here. What diversification strategies are you utilizing in your portfolio today? You should see this poll pop up, but we'd love to hear from you guys. Ooh, real estate. Love it. We'll take a moment and let you guys answer here. A lot of real estate fans. Love it. More stocks. Buying the dip. Okay. More cash. Okay. I love it. Okay. So we're seeing number one, we're seeing real estate. Number two, we're seeing more cash. And number three, we're seeing more stocks. Leanne, I feel your pain. Precious metals, very interesting, but I don't have a good root there. I'm not a big precious metal holder. John, gold and silver. Gold and silver, love it. John, good to see you, by the way. Okay, so these are some good strategies during this inflationary period, stagflationary period. These are some opportunities that you should definitely take a look at. Now, investor action plans for stagflation phases, stagflation stages. Stagflation, here's the good news, guys. We've talked about a lot of dark things here, a lot of concerning items, a lot of concerning charts and data. Here's the good news. Stagflation doesn't happen overnight. It's a process. Just like most economic conditions, there are telltale signs along the way to let us know what stage of the cycle that we are in, okay? We can see what's happening with what's going on in the market. Right now, we're going to go over the warning signs and the telltale signs of where we are at different stages of a stagflationary cycle. Let's take a look at each of these phases and the actions that you can take to protect your portfolio during these pieces of the cycle. All right, first things first, the early stagflation signs. When we're seeing the early warning signs of stagflation on the horizon. When we see these early stagflation signs, there are a few strategies that seem to be the best faring strategies in that environment. Number one, reduce long duration bonds. Number two, increase commodity exposures if you are inclined towards commodities. Number three, begin rotating toward value sectors and real assets that have real intrinsic values. And then last, look for opportunities to generate fixed income that outpaces inflation that's backed by real assets. Leaning into these strategies early gets you out ahead of stagflation and can reduce a lot of the pain or reduction in value of your portfolio. Next, we have the acute stagflationary phase, the acute stagflation phase. The steps that we're seeing consistently taken by the biggest groups in these phases are reducing overall equity exposure. This seems to be a time where equity volatility is very high. You see valuations reduced on companies. You see PE ratios going downward directions. I'll bring up a note here. I was reading a study by Schiller. It's the CAPE ratio that they do. What this is a graph to show where stocks are overvalued, where their valuations lie today. What the CAPE ratio by Schiller is showing today is that stocks could drop an additional 51% from where they're at today to being in range of real natural value historically. That's scary. Not only that, you're seeing things like Morgan Stanley, you're seeing things like Goldman Sachs. Their predictions over the next decade range between 0 and 3% annual returns for equities, for stock markets over the next decade. These are big groups that are very, very bearish on the stock market over the next decade. So once stagflationary trends once negative trends like we're seeing now really start taking hold, even the biggest groups are saying that they expect low to zero returns on stocks over the next decade. I encourage you guys to take a look at those numbers. So reduce overall equity exposure. Next is increase inflation protected investments to 25 to 30% of fixed income allocation. Okay. So this is leaning into fixed income options. This is leaning into options that beat the inflation outlook that we'd be seeing in the market, that are protected, that are safer, that are more on the spectrum of less concerns with a longer outlook. Okay. And then last, we've said it, but commodities, increasing commodity exposure over this period of time as well. And the last phase here, the late stagflation and early recovery phase of the stagflation cycle. This is the phase where we start turning the corner. We start to see some light at the end of the tunnel if we have to go through this stagflation rigmarole across the economy. This is where opportunity really begins, where we can see some growth opportunity on the horizon and a chance to lean into the economic recovery with our investments, okay? Steps that investors can take. They can add quality growth investments at reduced valuations, because at the tail end of this, growth investments are going to take a beating throughout. So getting growth investments at a reduced valuation is likely going to be a huge win if the recovery period and the economy is on the upswing. You're basically getting a discount at a period where we'll likely have a lot of upside in the future. Next, maintain or begin slightly decreasing that commodity exposure. If you're holding all those bales of wheat, then maybe it's time to start selling some of those off at this stage of the cycle, right? Also, you can rotate from defensive to cyclical sectors. Things like growth outlooks are improving. So the growth opportunities, not a bad place to be in a cycle that's beginning an upswing. And then last, prepare for potential monetary policy shifts, right? It's keeping an eye on what the Federal Reserve's doing, what the government's doing, what their strategies are to stimulate growth. There's the old saying, we've all heard it a million times, don't fight the Fed. So no matter what stage of any cycle we're in, keeping an eye on what policy is doing will benefit your portfolio if you're on the right side of those policy changes. Now, we see the stagflation cycle go full circle. The goal here is to rebalance in the new world and to be coming out with the best opportunities for the future market. So steps you can take in the post-stagflation world, right? Restore strategic asset allocation, have a more balanced approach. Diversification is a great opportunity at this stage. Reduce inflation hedges gradually, meaning don't take your foot fully off the gas here, but maybe growth and equity opportunities are a little bit higher. Maybe they're a little more stabilized after the stagflation world that we might enter into. Emphasize investments with leverage to benefit from economic recovery. Things that are well positioned for the new world we're in with the new markets that we're experiencing. And then lengthen duration in fixed income as inflation pressures may be persistent, right? So if inflation pressures are slowly on the way down, it usually does not mean we're out of the woods yet. Especially, I mean, we have entire webinars on this, guys. So I highly encourage you to check out our other webinars. Check out our YouTube, by the way. All of our webinars are on there. You can check those out. They're often an hour, hour and a half, 2 hours of deep dives, deep strategies, things like this where we're going over the charting and strategies of investing in different environments. So a lot of our investors are in the retirement phase or planning for the retirement phase. Because of this, we've started adding sections often of just focusing on retirement, how whatever economic principle or strategy we're going over affects retirees or planning for retirement specifically. So if you're in a mode where you're accumulating wealth for retirement, or you are already in retirement and taking distributions for your portfolio, stagflation can be very complicated for you. So let's take a closer look at this piece. Retirement planning. Let's look at this here. There are a few notable impacts on retirement planning. The combination of lower returns and higher inflation impacts retirement, especially in the accumulation phase, but also very much in the distribution phase, aka when you're withdrawing from your retirement accounts. So the traditional approach is that safe withdrawal rates are around 4%. We see that pretty commonly. In a situation of stagflation, these will likely need to be reduced during extended stagflationary periods or even inflationary periods. It's rebalancing along the way for what economic environment that we are in at that moment specifically. John, I see your question. We'll dive into that in Q&A. Perfect. Thanks, Angie. So we recommend considering allocating a portion of retirement assets to fixed income products in these types of environments, or to evaluate investments with inflation adjustment features, okay? There's a whole suite of products with a lot of different groups that lean into that. This would be a good time in environments like these to find out what a little menu could be for you for your retirement planning specifically. For those of you still in the accumulation phase, I'm still in the accumulation phase planning for retirement. Increasing savings rates becomes essential to offset the lower expected returns during these periods. If you're leaning heavily into stocks, you've already heard the quote of many big groups, Goldman Sachs, JP Morgan, their expectations are flat markets for equities for the next 10 years. So increasing saving rates will offset some of these lower returns. And we've said this, but we'll drill down specifically into this. The traditional 60-40 stocks and bonds portfolios represent a higher degree of risk than ever before in environments like these. Bonds underperform. We see this, right? We see rising interest rates negatively impact bond prices. We see this lead to losses for bond investors. We see undermining the traditional diversification that bonds historically provided. We also see stocks underperform, right? Slower economic growth, rising interest rates. These things tend to weigh on stock valuations, especially on earnings. So if you're looking at PE ratios and companies are making less money, well, their value is likely to go down, right? So this underperformance can impact a ton of public companies along the way. So stagflation causes unique retirement planning challenges. What we see, the combination of lower returns and higher inflation impacts the accumulation phase and the distribution phase. So what can you do about it? Options to consider for y'all. Allocate a portion of retirement assets to fixed income products that outpace inflation. This is one that we keep returning to, that we see big groups and smart investors and high net worths continually moving money towards. Next is delay claiming Social Security benefits. This is a strategy we're seeing more and more utilized. This allows you to maximize inflation-protected lifetime income. So that's an interesting strategy. There's a lot of notes there. We encourage you to take a look at that. In accumulation phase, increase investment rate to offset lower expected returns. This will allow you to stay on track with your retirement planning goals and maybe even get ahead during that time if you're making the smart investments. And no presentation would be complete with Saint without also covering the flip side here. Okay, so on the flip side, let's go through what not to do. Number one, have excessive cash holdings. Not to beat up on anybody that said they were holding cash right now, but just keeping large cash positions with high inflationary periods, there's a risk of loss of purchasing power. There's a risk that inflation, as it rises, will chip away at the value of cash. Okay, that's the concern here. So there are other cash alternatives. There's short-term tips. There's fixed income, there's fixed rate note investing. There's other options that can, hedge against inflation in a really good way that are, alternatives to cash. But just keep in mind that buying power and cash value will erode in inflationary periods. Next, we have avoid over-reliance on historical performance norms. The past performance patterns that we've seen often break down during stagflation. The exceptional returns, the 40-year bull market in bonds has created, pretty unrealistic expectations for fixed income. So similarly, growth stocks dominance, right? The last 10 to 15 years of growth stocks killing it may not continue in the environment in the future. Most big groups don't believe that to be the case. Also, avoid lack of diversification. Portfolio diversification is important, even if that means moving things to other places, but staying diversified. This means focusing on assets that will do well with high inflation. So right now, it's choosing right is the key in an environment like we're talking about. And then last but not least, don't get emotional. Don't do the panic selling thing, right? Increased market volatility during stagflation will likely or commonly lead to emotional decision-making for investors. We've seen this in stocks. We've seen this in many markets. So setting up a strategic rebalancing strategy before turbulence hits will save you from selling in a panic mode, right? We know that historically, if there's one lesson we've seen from chart after chart after chart, it's that time in market beats trying to perfectly time the market. So moving confidently to the investments you feel are the next best step, but not panic selling at the same time. All right. So key takeaways here. Key takeaways here as we start to, go full circle. Prioritize inflation protection. Make inflation hedging a core portfolio objective through real assets, through commodities, through fixed income strategies, through things that will hedge well against inflation in the future. The erosion of purchasing power beating the erosion of purchasing power is the name of the game when you're fighting against inflation here. Next is adjust return expectations, especially for the historical returns from decades of investing in the same things. That 60-40 portfolio very much should have a look at. You should have a look at that with your financial professional and see if that still will serve you in the future with the projections that many big groups are making right now. We had the everything bubble for over a decade, right? Now we might be entering the nothing bubble where everything's having issues. So choosing well is extremely important right now. And then maintain a balanced approach. This is avoid extreme positioning, right? Avoid the absolute extremes despite the conditions that we're in. Diversification is still important today, especially through the specific changes, the implementation that you got to do during tough periods like this. So navigating stagflation successfully requires defensive positioning and the flexibility to capitalize on opportunities as they emerge. So keep that in mind while we're going through these periods here, guys. And we will shift here to bringing your focus here on building a little resilience in your portfolio. What we talk about on nearly every webinar is creating an all-weather portfolio, considering investments that do well in up markets, down markets, etc., right? So these are some things that we see. These are some things that are part of our investment thesis that we see as good opportunities. So a few questions are in this vein. So I think this will answer this in a good way. The all-weather portfolio we see, we're looking at alternative investments, namely real estate. There are many real estate strategies that we see as a very good opportunity over the next 5, 10, 20 years, if you're looking at the underlying trends, because the tactical shifts in these environments are more important than ever to lean into and be on the right side of. So if you're looking for fixed income, I highly encourage you to be looking at things that are real estate backed that produce fixed income. On the Saint side, we have our Saint Income Fund. This is backed by real estate investments. This is backed by mortgages that are backed by single family homes, right? I love the single family home story right now. I love that model. You're dealing with payments that are 10, 20, 30 years that you can see into the future with an asset class that is arguably the most rock solid in real estate right now. So if you're looking at something like an income fund, I highly encourage you to take a look at the Saint Income Fund as part of your investment analysis. I saw John drop a similar question. John, let me know if this answers it. But this is what we're seeing particularly with mortgages in the US, which is our favorite asset class right now. Single family mortgages in the US. If rates go up, we see mortgages as more stable because people are less likely to refinance. The cash flow is stabilized. We're looking at, I don't know if you guys know this, but most of the world does not have 30-year fixed rate mortgages like the US has. We are in a unique environment. So investing in that with the strength and the power of single family homes, of what that market looks like today, huge opportunity. And when rates go up, there's also less turnover in our portfolio. So we have the opportunity to have a much more stabilized portfolio if rates increase in the future, which is a likelihood if inflation goes up. But if rates go down, I'm also bullish on US mortgages. Why? Because the underlying asset class is strong. You have baby boomers that own a massive percentage of homes in the United States. Most baby boomers, if you look at the polls, plan 10 to 20 years to stay in those homes. So if rates go down, it stimulates buying. It increases the value of homes. It stimulates investment into single family homes and often boosts returns, because if refinances increase, which is common if rates go down, then on the Saint side for our portfolio, that's great. It boosts our returns because we are refinanced at full price, but we've purchased those mortgages at a discount. So that boosts our returns. So when we receive those funds back, we just go and invest into more assets and bolster the portfolio with more mortgages. So our favorite all-weather scenario right now, our favorite all-weather investment strategy right now, are single-family mortgages in the United States. Also, we talked a lot about different investment strategies, but the focus today was on stagflation. So if you're interested in a deep dive on portfolio diversification and why the 60-40 portfolio does not work, it does not cut it in today's environment and with what we're seeing, I want to plug our next webinar next month. And by chance, do we have the link for that? I'd love to drop them the link if they could sign up now.
Not yet, but we will send it out this week for sure, I promise.
Perfect. So everyone attending here, next month's webinar on May 28th at 5 p.m. Pacific is on portfolio diversification. We're taking a deep dive. We are taking pages out of the book of huge groups, Tiger 21, major investment groups, and seeing what they're doing for portfolio diversification in the coming decade, in the coming years, with the economic trends that we're seeing. It will be great. It will be a great webinar. I highly encourage you guys to check it out. So book that on your calendar here. You'll be getting an email from us soon in the next week or so with a sign-up page. So you guys can check that out. Keep an eye out for that one. And then if you're interested in learning about how we are investing through the trends that we're seeing, through the things that we covered, through a stagflationary environment, here is a link. You can either hit this QR code here and book a call to learn more about what we're up to on our income fund with over 500 mortgages backing up the fund in over 21 states, returns up to 14.28% annually here. You can check this out. The number is also on the screen here, as well as you have the calendar dropped in the chat. So you can book a call with Tom. You can learn from Tom about what we're doing, and he can drill down on your specifics to see if it might be a good fit for your portfolio. In this fund, I'll make a note here. I personally have invested over $600,000 of my own money into this fund. I got a big payout just a handful of months ago and was looking around the investment world at different opportunities. I personally did not find a better option than what we are doing. So I personally endorse it because I personally invest in it. So if you want to learn more, book a call with Tom, or you can call. His number is in the chat, as well as the number is up here. And the last housekeeping item for y'all. We post all of these deep dives, all of these webinars, all these long form explanations and analysis on our YouTube channel. So right here is a QR code that will take you to our YouTube page. You can check out the past webinars. We've done all kinds of great ones. We've done a demographic analysis of the baby boomers, the 75 trillion that they have in wealth, where that money plans to go. We've done a deep dive on the stock market. Is it risky? The answer is yes. We'll go through the numbers exactly of what that looks like and the different trends that we're seeing on that. We also have upcoming webinars that you'll see on there. So I highly encourage